What up, YouTube? It's your boy Charles Enoch. Y'all already know we back with another Invest in Myself episode. So roll the intro. So you already know, before we get started, your boy gotta do the YouTube thing. So my goal is to reach 10,000 subscribers before the end of this year. I know it's a crazy goal, but it's my goal. So let's make this thing happen. So if you're new to the channel, go ahead, take 2 seconds, hit that subscribe button for me. Also, take 2 more seconds. Remember to hit that like button for me as well and leave a comment down below. I appreciate anybody that does all 3 of these things because it does help me reach a higher audience base. So I know I've been out for a few weeks, so I apologize. Got back from Kansas, visiting family, and I was able to check on my rental property, so it was a much needed break. But anyway, today I wanted to go over a real quick example on how to pay off a personal loan using your credit card. So taking advantage of credit cards that offer balance transfers that are 0% for 12 to 18 months can save you a lot in interest. So there are basically 3 ways to do a balance transfer. So not all credit cards, but some will let you log into your online account and do a balance transfer and transfer the funds right into your checking account. So for example, I have a Discover card, and when I log in and want to do a balance transfer, all I have to do is enter in my routing and account information, and it will transfer the balance of my credit card limit, whatever I choose, right? So if I have a $10,000 limit on my Discover card and I decide to use $8,000, it will pretty much transfer $8,000 into my checking account, and then there will be an $8,000 balance on my Discover card. Now, the other option you can do, sometimes your bank sends those convenience checks in the mail. So it's a check that you get that's attached to your credit card, and you can actually write the check to yourself and cash it. So the last option, sometimes your bank can just send a check to whoever your lender is, and pretty much it will pay off or down the loan. So in a nutshell, what we're doing when we're paying off the loan is we're going to be using that balance transfer, transferring the balance onto the credit card, and we got 12 to 18 months to pay that off. So we're going to use our cash flow, which is pretty much our leftover after our income comes in, and then we pay all of our expenses. Whatever the leftover amount is, we're going to apply that towards the credit card. So since the credit card is 0% interest for 12 to 18 months, whatever your offer is, you're accruing no interest. So you want to make sure you pay off the credit card in that allotted amount of time where you are being charged 0% of interest. So I know this may sound complicated, but we're going to work an example on the debt payoff calculator in an Excel sheet to see how much interest somebody can save and how fast you can pay off your loan. So let's get to it.
All right, so we're on the debt payoff calculator here. So we're going to have a brief example. Let's say we have a couple. Their income is going to be $4,000. Their expenses are going to be $3,500. And we have a scenario here where they have a loan and they got a $10,000 personal loan. We're going to say the interest rate is 15%. And that personal loan, they got it for a period of 5 years. Obviously 12 payments in a year here. So their scheduled payment amount is going to be $238, and they have to make 60 payments here. So we see that the total interest would be $4,274 if they were just to pay the minimum and pay all 60 payments. Now what this individual is going to do, let's say that they found a credit card at a credit union and they're offering a balance transfer for 12 months, 0% interest. So, and let's say that they have about $8,000 on that credit card that they can use. So first thing, what we're going to do is use the cash flow difference. Now their cash flow difference, if we remember, the income's $4,000, their expenses are $3,500, so that's $500 of cash flow. What we're particularly going to do is be conservative and say, hey, they only have $400 of cash flow just to be safe, because when we're doing this calculation, we want to make sure that we're able to pay off this credit card within the 12 months where we have 0 interest. So if we do 400 times 12, I think that's $4,800. So the first payment, we're going to put $4,800 for the extra payment. Now we see the total interest again, $4,280, 60 payments. Now when we're doing that chunk payment, let's see how it's going to reduce the total interest here. So we see that the interest got reduced tremendously here. Now since we made that chunk payment, we pretty much paid off half the loan. So now the total interest, $9,993 or $993. I'm sorry here. So I mean, we pretty much saved a significant amount of interest, and we see the actual number of payments now to be made is 27 payments instead of 60. So since we hit it on the front end of the loan hard and put that extra payment, we are saving way more than half on interest. Now, again, the extra cash flow that we have, the 400, we're throwing that onto the credit card for 12 months here. So let's count this down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So month 12, they pretty much have the credit card paid back in full. And remember, they are still making the monthly payments because this is part of their expenses that they calculated in. So you're still paying the monthly payment, you just put an extra additional chunk on it. So when we see we're at month 13, $3,045. Let's say that they have another balance transfer. They found another card, or a lot of times that card has the same promotion around the same time. So you're able to use it again and again and reuse it. So let's say that they are going to pay off the loan, $3,045.24. And we see the total interest from $993, number of payments 27. So boom, we see that we even saved a little bit more interest, about $200. So the total interest we saved, because it was about what, $4,300. We saved about $3,000. I would say about $3,500 just to round here in interest by using this particular method. So we're doing this balance transfer. They have 0% interest that's being accrued, and then your cash flow is going straight to the credit card to pay it off. Now this is very simplistic way, but I just want to show you guys this is an awesome way to save a lot in interest by using these credit card offers and doing that balance transfer, paying off the loan. If you pay it off on the front end, you're going to save the most interest. Now, if you're close to getting this paid off, then you're going to save less interest, because how amortization works, the front end of the loan, you're going to pay more of the interest. So we even see right here, even still, interest is $125, and the interest is only $38. So we see that the interest gets lower and lower from the payment. So if you're able to tackle it at the beginning of the loan, you're going to save a significant chunk of money. So we'll go over other scenarios where the loan amount might be a lot higher and more in depth Again, if you have a specific scenario, please email me. We can put this into the debt payoff calculator and see how the numbers add up. So hopefully this was helpful. I know it was a short video, but I want to get simple, straight to the point. If it was helpful, definitely leave a comment. If it wasn't, leave a comment as well. Let me know how it wasn't helpful. If you guys have different ideas of what you want me to do in regards to velocity banking or even with the debt payoff calculator, let me know as well. So like always, you guys have a good weekend, and if you haven't done so, remember to subscribe and like. Peace out.